Hey everyone, me Kevin here. I just came from the Federal Reserve. As you can see, I got my St. Louis Fred shirt on here, and it is a disaster over there. Everybody's freaking out. There are papers everywhere. Things are on fire. People are throwing fire extinguishers instead of using them because they've never been taught what the hell to do. They're behind on the tightening cycle, and Jerome Powell is freaking the heck out. And in this video, we are going to explain a few things, and they're going to be very powerful. Number one, we're going to talk about how much we actually expect stocks to decline in an earnings recession. We're going to use some insight from some really big firms for this. Number two, we're going to talk about if we have those big declines, when do we generally see the bottom of the market? This is very critical information, so buckle up and we're gonna get right into it. Of course, I do have to mention that this right here is brought to you by Ray Dalio's firm, Bridgewater Capital. That is this piece of paper, this PDF here. This video is not sponsored by them. This video is, however, sponsored by the courses on building your wealth, including the real estate and stocks and psychology of money courses, which people are bundling up on right now using the coupon code we have. It's our most popular bundle because people see the writing on the wall that this could be the bottom of the market for stocks, or it could be getting slightly worse, and we want to be prepared. And we are walking into a recession in real estate, and there are going to be huge opportunities to build wealth in real estate in this cycle. So get educated, learn that, and join the programs before the coupons expire. And we go live every single morning when we have a market open live stream together. We've got about 1,000 people that we get together every single morning so we can do fundamental analysis on stocks, real estate, or answer your questions. So Ray Dalio has the following piece, which we're going to be breaking down. It's Ray Dalio's firm that has this piece. And it's really interesting because it gives us some insight and some more color into what we've previously been considering when it comes to investing. And that has to do with how much we actually think the market could fall and in what phases, right? So for example, when we go over here and we look at one Goldman Sachs piece here, we find out that there are two phases of a market crash. Number one is when multiples go down. So for example, if you have a stock that has $10 of earnings per share and it's trading for $100, well then that is trading for what's known as a 10x price to or earnings to price multiple. Price to earnings multiple is what we call it, PE ratio, right? That's 10x. Well, if the multiple compresses to 7x and the earnings stay stable, now your stock actually falls 30% to $70, simply by what is called a compression in multiples. Now that's phase one of the market cycle, as Goldman Sachs tells us here. Price to earnings ratios fall. Unfortunately, phase two is an earnings per share crash. Now that is actually where now you have this lower multiple, but then you also go over here and let's say you cut earnings per share to say $5. 5 times 7 is now $35. Look at that. You've got another 50% crash in a stock price, right? That, folks, is scary. And what's fascinating is we actually have some insight from Ray Dalio's firm in terms of how bad they think the market could actually get overall, not just company or example specific. Now, this is a very complicated read, but I'm going to simplify it as much as possible because I've already gone through it and done the hard part for you. They start off by talking about, hey, the stock market has had a pretty crappy 2022. Wow, if only somebody in like January of 2022 would have told us that 2022 is going to suck. Oh wait, that's what I did. People didn't like it. People called me a fudster when I warned, but whatever, man, whatever. People are gonna leave whatever comments they want. And so this is the 2022 that we have experienced. In contrast to the 2 COVID years before that, we have had a pretty volatile year. In fact, we are now within 7.5% of the bottom of the market on the NASDAQ 100. We're sitting at 289. The low was 268 for like a day. And folks, I didn't think we can get to 268 again unless we saw inflation go over 9%. But because inflation is broadening and it's staying higher for longer, and we think the Fed is going to have to raise rates for longer, yields on treasury bonds are going up and the stock market's going straight down. You can now get 4% on a 6-month, 1-year, or 2-year treasury. It's absolutely insane. That's risk-free 4%. It's crazy. It's actually what we're going to be using for HouseHack while we wait to deploy our money. HouseHack, by the way, if you're an accredited investor, is my real estate startup, which we'll be buying once the market crashes, and we're preparing now so we can go bottom feed. Let's go! If you're non-accredited, we're working on that process. But anyway, Webull shows us very clearly that we have had a beautiful bull run that has turned into disgustingness. And now we have to deal with that disgustingness and figure out how much further is all of this going to fall. This, by the way, is Webull. You can go to metkevin.com/Webull to get up to 12 free stocks if you sign up and deposit some funds with Webull. It's a great platform. I love it. So going to Ray Dalio here, what do we have? Well, we have Ray Dalio telling us that if the tightening that we currently have priced into the stock market does not reflect enough of Fed action, then obviously stocks are going to go down more. In other words, if the stock market is mispricing how much the Fed is going to do, then obviously stocks will go down, right? That's obvious. That's the easy part. But they make this really neat argument that I'm going to distill on this piece of paper here because it's a little complicated. What they basically say is, we need an earnings recession. I'm gonna nickname this ER because it's kind of like we have to go to the emergency room, okay? Because it's gonna suck. They're saying we need an earnings recession. They also say that if we end up getting inflation that comes down, but we still do not have an earnings recession and inflation does not come down enough, then the Fed will have to tighten more. So they'll have to tighten more. And they'll actually end up having to cause that earnings recession. So in other words, if we have pain in the markets, but we don't have an earnings recession, then the Fed's just gonna end up tightening more and they'll cause that earnings recession. That is what they say in very complicated language right here, which is remarkably scary because in plain English, when you go to my bubble number 2 right here, and they say this in very complicated words right here, like tightening cycles are bad for all assets because as discount rates rise, the present value of future cash flows of those assets, price gonna go down, folks. Price gonna go down. It's not good, but it creates some opportunity. And so this is where we want to know, well, how much our price is going to go down and when our price is actually going to hit bottom. Well, we have research for you to tell you exactly this. Take a look at this. Ray Dalio's firm believes that the markets are not pricing in a discounting or decline of earnings. And this is consistent with what I'm seeing across hedge funds and institutional investors who are saying, yeah, we are not pricing in an earnings recession. This is bad. And so this is where Ray Dalio gives us the following potential scenarios, and his firm give us the following potential scenarios in terms of how bad the crash could be. So what they say is if we have a crash, a PE multiple crash with no earnings recession, we tend to see a crash of 20%, a correction. If, however, we have a multiple crash with an earnings recession, contrasted with no earnings recession here, then we could potentially see a crash in markets that is substantially higher than that. In fact, here, I should clarify, with a price to earnings multiple crash with no earnings recession, they see a 10 to 20% crash. With a price to earnings crash and an earnings recession, they see an over 20% crash. And they give us the scenarios right here. They think that if we have an equity drawdown, we could potentially see a crash along with, so a price to earnings multiple drawdown along with an earnings recession. We could potentially see an average of a 37% decline. 37% average. That's pretty painful. Whereas if we only have a correction and we don't end up having an earnings recession, we might only end up seeing a 15% decline. Now, generally, when we talk about market-wide declines like this, we just use the S&P 500. So if you wanted to look at the S&P 500 right now, all you would have to do is type in SPY stock into Google. You could press the little year-to-date button and you could see that the S&P 500 is down right now about 19.5%. which would be roughly consistent with a correction, only a price to earnings recession with no earnings recession. However, we still have roughly twice that to go if we do end up having to price in an earnings recession. And there's a very specific reason that I wrote on this Ray Dalio piece right here, Tesla. No, it's not just because I'm biased and I own a crap ton of Tesla shares. And yes, I know that course member Steve, who loves Dell, uranium, and commodities. Shout out to you, Steve. I love the contrarian opinions, and I respect them, okay? It's not just because I had a debate with Steve this morning that even Tesla could face an earnings recession, says Steve, and to which I replied and said, I don't know, man, last Q3 we delivered 250,000 vehicles. This Q3, we are expecting to deliver 369,000 vehicles, okay? Going from 250-ish to 369, big bump. Then we got to like 306,000 deliveries in Q4. So this was Q1, this was Q4 last year. So our year over year is gonna look good. We're expecting to be at about 460,000 vehicles by Q4. This, along with the fact that Tesla prices for their cars have skyrocketed and commodity prices are falling, as Elon Musk tells us on Twitter, I don't know. I don't see Tesla having an earnings recession, especially with over 400,000 vehicles to be sold in terms of excess demand. That's just the excess demand curve. That's not even the current demand curve. It's incredible. So in short, I have this whole tangent here on why I think Tesla is going to be one of the few stocks that is actually immune to an earnings recession. And in 6 months, we're all going to go, holy crap. The only company that, or one of the few companies that's still growing earnings and has a serious growth rate during a recession is Tesla. Oh, well, I mean, whatever. It gives me more time to buy shares the more people doubt it, but that's okay. But anyway, let's keep going over here with what we think about actual drawdowns. So rising yields and expectations of the Fed having to hurt us are going to hurt the market to the tune that we've already described. And tightening typically becomes or ends once it becomes clear that inflation is about to peak. This was a really interesting lesson. So basically this chart is telling you that when it looks like the Fed is going to U-turn, that is when we actually see a tightening end. And the only way we see that is when we see a peak in inflation. So basically, in order, you see a peak in inflation, the market expects the Fed to U-turn, then the Fed U-turns. Okay, that's generally when we have a Fed U-turn, good for stocks. Now, what do we think? And what else can we get out of this? Well, first, this was the chart that we talked about in terms of equity drawdowns. I think we have one more note here, and then I want to talk about when the market is actually likely to bottom. Oh, two more notes here. Okay, two more notes, and then when the market might actually see its bottom. So this note here shows us the projected expectations based on Bridgewater Capital's expectations of what earnings are actually going to look like, the earnings growth rate. And you can see that in the dot-com bubble, we bottomed in roughly in 2003 in terms of earnings growth. In 2010, we had roughly our earnings growth bottom after the 2008 recession. So the earnings, the EPS bottom tends to come after the bottom of the market. In fact, keep in mind, the stock market bottomed out in the 2008 example in February of 2009, which is probably where that green dot is. So you have a delay in when earnings growth bottoms and when the stock market bottoms. Like the stock market was already recovering when we had a bottom here. And so Ray Dalio's firm is anticipating we are going to see a substantial decline here in earnings growth rates. And that can lead to some pain in the stock market for the short term, but we'll probably see a bottom at some point. Of course, we're going to see a bottom at some point. But when is that bottom? And folks, this is where we get to the next part of the video and another piece of research that is critical. If you have made it this far in this video, you are awesome, first of all, because some people literally sign up for the notifications just to leave a hate comment. Fortunately, it's a small group of people, but imagine how miserable you have to be in life to take really high quality information and just within the first minute leave a hate comment. Like, I want to just take a moment and thank you for making it to this part of the video. I think you are somebody who actually appreciates perspective and knowledge and deep information. Like, I like to go above and beyond just buy index funds or here's what the CNBC headlines are. I like to go deep and I like to provide my own conclusions. Unfortunately, when I give my own conclusions, I can be wrong, but at least I give you my perspective, and that's my opinion. And sure, I'm becoming a licensed financial advisor, but that doesn't mean anything in this video is financial advice for you. I'm just doing the best that I can, not only for myself, my family, but also for our startup, because my reputation is on the line with this company, HouseHack, that I'm going all in on. So I need to do right by every single investor in HouseHack, and if you're an accredited investor, I invite you to check it out by going to househack.com. Y'all know me. I'm a workaholic. I love working, and I will do whatever I need to do to make sure House Hack succeeds. I'm very, very excited about that. But anyway, let's talk about this potential for when do markets actually bottom when we have an earnings recession. And folks, I already have that research for you because I'm the kind of guy who stands around reading or sits around all freaking day long to get this sort of information. Take a look at this, folks, okay? Goldman Sachs believes the bottom of the market will occur 6 to 9 months before the earnings bottom. This means expectations following will hurt the market more than the actual earnings falling. I wrote the yellow box, okay? I translated the little X there into my yellow box. This means we hit bottom about 3 to 6 months before we have our bottom in earnings growth. So yes, Ray Dalio, you're correct. But just like historically we have hit a bottom beforehand, we will probably hit about, that's probably not the right place to draw that dot. We'll probably hit a stock market bottom, which we may already have, 3 to 6 months before earnings bottom. So when would we likely see the worst EPS falls? Probably towards the end of this year, when we start lapping the insanity that was last Black Friday. Like when this Christmas season sucks because Santa Claus ain't coming because the housing market is crashing and the stock market has crashed, we will have some of the worst year-over-year earnings. And so then we'll get those reports and we'll see massive negative earnings growth in about January and February. So in January and February, we're going to see probably the worst of the earnings recession in January and February. But if the stock market actually bottoms 3 to 6 months before that, we could potentially be at the bottom now, or it could be in a couple months based on that sort of historical range, which makes me very excited to look at this and go, let everybody fearmonger and FUD over the earnings recession. But I'm a buyer, baby. Not only am I buying stocks, but I'm obviously also diversifying into real estate. And I'm doing that via House Hack. Now, I will never tell somebody not to buy their own home. I think you could do very well buying your own home. And you can learn my ways with the real estate investing course. You can learn a download of my entire brain and how I operate. But if you don't want to deal with that, and you're an accredited investor, consider investing in House Hack. And maybe in the future, we'll have an investment opportunity for non-accredited investors as well. I'm still working with the attorneys on the paperwork for that, so stay tuned. But make sure you go to househack.com because this video is not a solicitation. You have to go read the PPM. That's your solicitation. All right, folks, good luck out there. What am I doing with my money? Again, I think this could potentially be where we're like, look, I'm not calling a bottom here, but I'm saying these are the ranges that I want to be buying in. In fact, if you just sort of look at the typical cycle of prices going up and prices going down. Let's make that a little more extreme, right? Over time, prices go up, prices come down. Prices go up, prices go down, right? These are cycles. This is the business cycle. Do I want to buy here and sell here? Duh. Everybody and your mom wants to do that. Duh. But what's realistic and what's generally a better way to do it, in my opinion, is you sell when we're here. So when you're above that line, you sell. That is realistic. When you're in these euphoric times like in November, you sell. And guess what I was saying in November? It's time to start selling some of our positions and getting out of margin and maybe even short ARK Invest, which I did at the beginning of December of last year. Wish I held on to it for a lot longer. But the point is, I was one of the few people saying sell around this period of time. And I didn't sell everything. I wish I did in hindsight, but at least sell some. You can't be perfect. At least sell some. The same is true over here. Is you can't be perfect and nail the bottom perfectly, but at least be a buyer here. Not financial advice, my opinion. Okay? Thank you. Good luck. There is coffee in this for the losers who think I don't have coffee in my mugs. Sometimes I do finish the coffee right before and then it's empty. See? See that liquid gold there? I don't think you can really see it. Is that obvious enough? I don't know. Okay. I just spilled on my pants. Dang it. And they're white. Now it's empty. So now the people who don't like me can clip this and go, oh, Kevin's mug is empty. He's not actually really drinking coffee. Thank you to the supporters, because some people are just miserable people, but they have bad days often, and I wish them better days ahead.